All right, welcome to the Explainer. Today, we are diving deep into the quantitative mechanics behind two completely opposing corners of the trading universe. On one side, we've got the absolute fundamental void of cryptocurrencies, and on the flip side, the fundamental everything of global macro. We're drawing directly from the incredible breakdowns in 151 trading strategies to see exactly how quantitative algorithms navigate both of these wild extremes.
So here is our roadmap for today. We'll be going from the crypto fundamental void to neural networks, crypto sentiment, macro trading styles, momentum and inflation, and finally, global bonds and economic announcements.
Okay, Section 1, the crypto fundamental void. We need to establish why assets like Bitcoin and Ethereum force quantitative traders to completely throw traditional valuation models right out the window. Think about how you'd normally value traditional equities or bonds. You have real-world cash flow primitives anchoring your models, right? You've got earnings, dividends, yields, but with cryptocurrencies, well, you have zero underlying cash flows, nothing. So without those basic building blocks, quantitative strategies are basically forced to rely entirely on trend, momentum, and sentiment data mining. The researchers in 151 Trading Strategies hit the nail on the head here. Since there are no evident fundamentals for crypto assets, machine learning isn't just some optional optimization tool. It literally replaces traditional fundamentals altogether. And that sets the stage perfectly for the highly technical strategies we're about to unpack. Moving right along to Section 2, Neural Networks for Bitcoin. Let's dig into our very first specific strategy and see how an artificial neural network, or ANN, tries to predict short-term Bitcoin movements. Let's trace the actual flow of data in a canonical crypto forecasting model. First, the input layer sucks in a bunch of technical indicators. We're talking demeaned returns, exponential moving averages, and the RSI. Then, that data feeds through the hidden layers of a feed-forward network. It applies mathematical filters, specifically the ReLU activation function, to sniff out hidden patterns. Finally, the output layer generates a forecast, dividing future Bitcoin returns into K-quantiles or buckets.
Now the real magic happens at the very end with a softmax function. It takes all the messy, raw numbers spit out by the neural network and elegantly translates them into a clean probability distribution. So the odds of the price going up, down, or sideways will always sum to exactly 1. And to get smarter over time, the algorithm minimizes what's called cross-entropy loss via stochastic gradient descent. Basically, it mathematically punishes its own bad predictions.
So what does this all mean for the actual trade? After all that complex math, the execution is incredibly straightforward. The algorithm simply buys if the predicted top quantile probability is the highest, and it sells if the bottom quantile probability is the highest. It just systematically buys the predicted winners and sells the predicted losers. Let's pivot to Section 3, Naive Bayes Crypto Sentiment. Here, we're looking at our second crypto strategy, which swaps out price trends for natural language processing to mine social media sentiment. Instead of using technical indicators, this model relies on a learning vocabulary built from a massive corpus of tweets. It constructs a binary feature vector for each tweet using a naive Bayes-Bernoulli distribution. Why naive? Well, it applies Bayes' theorem with the mathematically naive assumption that the presence or absence of a specific Bitcoin-related keyword is completely independent of any other word in that tweet. It treats every single keyword like an independent coin flip. Imagine a tweet hitting the feed. The algorithm instantly scores it. Is the keyword moon present? That's a 1. Is the keyword hack absent? That's a 0. By calculating the conditional probabilities of these binary 1s and 0s against historical market moves, the model predicts whether the crowd is about to buy or sell. Once again, pure mathematical sentiment analysis is totally replacing traditional fundamentals. All right, Section 4, Macro Trading as a Style. We are now completely leaving the pure data mining void of crypto behind and arriving at the exact opposite end of the spectrum, global macro, the fundamental everything. You really have to wrap your head around the fact that global macro is not a single asset class. It is a massive cross-asset investment style. Macro algorithms reapply fundamental logic at a global scale, trading systematically across stocks, bonds, currencies, and commodities to capitalize on huge regional, economic, and political shifts. That brings us to Section 5, Macro Momentum and Inflation. Let's examine how systematic macro traders actually build models around these massive global shifts, starting off with fundamental macro momentum.
To objectively rank global equity indexes, quantitative models score entire countries across 4 foundational state variables. They look at the business cycle using one-year changes in real GDP and CPI. They measure international trade via foreign exchange rates against export-weighted baskets. They track monetary policy through short-term rates. And finally, they gauge overall risk sentiment. It is a highly structured, strictly data-driven ranking of global economic reality. But check this out. This is the fascinating part. Whether an algorithm is using Twitter to predict Bitcoin or global GDP to rank countries, the ultimate execution logic is exactly the same. The system simply goes long on the top decile, shorts the bottom decile, and typically holds that position for 3 to 6 months. Different inputs, same exact math. Now let's explore how macro builds into inflation hedging. When a global exogenous shock hits, like a massive geopolitical event, it immediately spikes headline inflation. But it takes time for that shock to slowly filter through to core inflation. This mathematical lag between the fast-moving headline numbers and the slower core numbers creates a highly measurable arbitrage window for quants. So they use a formula to systematically calculate the optimal inflation hedge. The commodity allocation is basically the maximum of 0, or the minimum of the year-over-year headline inflation minus core inflation, divided by headline inflation, capped at 1. In plain English, the wider the real-time spread between headline and core inflation, the more capital the algorithm dynamically dumps into commodity ETFs or futures to protect the portfolio. Finally, Section 6, Global Bonds and Economic Announcements. For our final act, let's look at how macro strategies systematically trade government debt and exploit major economic calendar events. Just think about the sheer volume of fundamental inputs required to systematically rank government bonds. We're talking about a cross-sectional analysis, using everything from the output gap and sovereign risk to real interest rates and term spreads. It really proves just how deeply anchored in economic reality these macro models are, especially when you compare them to the purely technical indicators we saw back in the crypto void. And one standout factor in that massive list is the Cochrane-Piazzesi predictor. It's a very well-known fixed income forecasting factor that uses a combination of forward interest rates to systematically predict excess returns. By factoring in advanced metrics like this, the algorithm can accurately isolate the top quantile country bond ETFs to buy and the bottom quantile to short. To wrap things up, let's look at a pure event-driven macro strategy. Empirical evidence consistently shows that equities actually yield higher average returns on days when the Federal Open Market Committee makes major announcements. Because these specific days dictate the cost of money globally, algorithms track these announcement days versus standard non-announcement days to systematically capture that historical premium. Because of this powerful, proven historical effect, the strategy mandates a 100% allocation shift. The algorithm buys equity ETFs on the announcement days to capture the upside, and then shifts exactly 100% of the allocation straight back into risk-free assets, like U.S. Treasuries, on non-announcement days to protect capital. It is absolute binary precision applied directly to global monetary policy schedules. We've seen today how algorithms bridge the massive gap between Twitter sentiment and global GDP, relying on the exact same core logic of quantile ranking and mathematical probabilities to find an edge. But the real question I want to leave you with is this. As markets become increasingly automated, where do you see the greatest alpha hiding tomorrow? In the fundamental void or the fundamental everything? Thanks so much for joining me on The Explainer.